You know, growing up, there were a lot of things that scared me. You know, things that went bump in the night, ghosts, vampires, werewolves, monsters. Now, those things don't scare me anymore, at least for the most part, but there are some things that scare me that I want to pay attention to in the real estate market that we want to be looking at going forward. Look, the Fed has pretty much tamed inflation, meaning prices haven't came down when you go to the grocery store, but the prices, as far as how much inflation is accelerating, the Fed feels like is under control. So they are now looking at some other numbers, and we, both as home buyers, investors, and people in the mortgage and real estate industry, want to make sure we're paying attention to those numbers as well. Hey everyone, this is Rayce Robinson, your favorite Florida mortgage broker. And did you know that right now FHA foreclosures, FHA delinquencies are higher than what they were in 2006, 7, and 8? And you might say, how could that be? And this is a good way to understand headlines and the way that they work, is because even though there were a lot more delinquencies in 2006, 7, and 8, a tremendous amount more, we just weren't doing that many FHA loans. So there are more FHA delinquencies because we have been doing more FHA loans, especially over the last few years. But that does not matter when you look at the overall market, because in 2006, 7, and 8, delinquencies were a huge thing and FHAs were just a little sliver of those delinquencies. So that's just the way headlines can be twisted. Another thing is, let's look at rates before we get into the things that scare me, because you know what? This is a mortgage and real estate channel. So when we look at interest rates or look at the market, today, at Friday anyways, the rates ended at 6.2%. Now remember, everyone's rate's different based on credit score. Usually rates you see advertised are going to be the best possible scenarios, but I'm more interested in the trend. And you can see that the trend has for us to continually go down really since the beginning of the year. And now, even though we did get this tick up after they lowered the Fed funds rate, the trend is going to continue to go down, especially throughout this year. Next year, really the estimate is for rates to get down in that 5.5% range. We shall see. Now, note one other thing that is going to change in 2025 is the maximum conventional loan limit, which is important if you're in the real estate and mortgage world. Currently, it's at $766,550, and it is scheduled to go to anticipated $802,650, which means that people that did have to do a jumbo loan now maybe can do a regular conventional loan. Now, what are the three numbers that we really want to be paying attention to? And of course, the Fed is paying attention to this too, because they started out with a 0.5% rate cut, which the last time they did that was in 2007 as the Great Recession started. So obviously they're worried about something. And what is that? They're most likely worried about unemployment. The Fed's mandate is a dual mandate to actually stabilize prices and at the same time give maximum employment. So let's take a look at unemployment. This is the current rate over the last 5 years. I thought this was interesting during COVID. We had this big, obviously increase in unemployment as businesses shut down, were forced to shut down, and people were sheltering in place all over the nation. And then obviously unemployment has went down since then. But if we zero in over the last year, you can see slowly unemployment is starting to tick up. And that's important because the Fed is actually seeing this unemployment rate go up. And also remember, when you look at the Bureau of Labor Statistics, I think they also understand that these numbers are skewed because government jobs skew those numbers, meaning the post office or DMV is not laying off regardless of what the market's doing. But when they look at things like ADP payroll and these different things, they also see that there is a slowing decline in the amount of hiring and people that are getting laid off, and really just businesses not hiring as much as they were. And the way you can look at that is a thing called the JOLT report. And this is another graph that we can look at over the last 5 years and see that the rate at which people are getting employed is starting to slow. So that just means that unemployment is something that's on the Fed's radar, and we're going to be tracking it here as we do these weekly updates to see if unemployment is going to tick up. And when we look at the numbers, I believe that is what the Fed is really paying attention to, and how low the Fed funds rate could go. The second thing that scares me is if rates get in this middle ground between the 5 and 6% range. And the reason that is because I don't think it unleashes a lot of supply, but I do think it brings in a lot of demand, or at least people that have been sitting it out, wait for lower payments. We're already seeing mortgage applications starting to trickle up. And I really think in that 5.5%, 6%, 5% range, we get demand, we don't get enough supply. And even Jerome Powell, I was looking at this article here where Jerome Powell said the Fed alone cannot fix the broken housing market. The market and government will need to do so. And he talks about in this article that the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in, meaning that conversation where people have lower rates and they don't want to trade their low rate mortgages in for a higher rate to move. And low rates, people don't want to sell their home because they have a very, very low rate mortgage and it would be quite expensive to refinance. As rates come down, people will start to move, and this is probably already happening. But remember, when that happens, you've got a seller that also becomes a buyer. And the real issue with the housing market is that we have had and are on track to continue to have not enough housing. And then he also goes on to say, Jerome Powell, the housing market is in a very challenging situation right now. You have this longer run housing shortage, but at the same time, you have a bunch of things that have to do with the pandemic and inflation and our response with higher rates. You have a shortage of homes available for sale because many people are living in homes with very low mortgage rates. And again, talking about this lock-in effect. So what is he saying there? He's saying that the concern is not inventory going up. The concern is demand coming back into the market and already strained supply and builders not keeping up with demand, driving prices up. Now, it is important to note in Florida, we actually are at pre-pandemic levels, but at the same time, you're going to probably see that start to stall out. Remember, I can't promise anything. Don't get your financial advice from me. But as rates go down, that inventory is going to start, or that's going to start pushing people back in the market. They're going to buy these homes. Now, the third thing that scares me the most is government intervention. Now, regardless of what side of the political aisle you're on, candidates, parties like to do things that get them votes. And one of the things that always gets people votes is doing incentives for people to get into home ownership. Let's face it, it's the American dream. But the worst thing that the government could do, in my opinion, is do any type of incentive that on top of rates falling starts driving buyers back into the market. Now look, as a mortgage professional, I would love that. That means more money for me. I get to originate more loans as people take advantage of these programs. But as an overall health of the market, it really bothers me, or at least worries me, because that is how you get these situations where housing prices continue to go up. We really want kind of a flat market with slow appreciation as income catches up, rates start to fall. Having this runaway appreciation is not what we want. And the government is notorious for getting involved and having these unintended consequences, which is not what we want. So those are the three things that I'm really paying attention to. Number one, unemployment. Regardless of what housing does, if a lot of people get out of work, then that is going to impact the market. Now, as unemployment goes up, Fed will probably lower rates even more, and we see how those things balance out. But it is something we definitely want to be paying attention to, because it definitely could affect the market. Two, how low rates get, because we want rates to get as low as possible, because we want to release some of that lock-in effect, or people that aren't moving or aren't selling because they've got such low rates. So I think in that 5.5% to 6% range is really the worst place for rates to be. And number three, the big one, we do not want the government coming in and pouring gasoline on the market and pushing housing prices up. We want the market to perform as the market does and let some of this stuff work out through supply and demand without the government actually goosing the market and getting more buyers to enter the market. So that is what I think the most important things to track are, especially going over the next 4, 5, or 6 months as we get into 2025. Now, the opportunity to use this information, I think some people are actually still waiting for a big market correction. And the opportunity, especially in Florida, with more housing inventory than we've had in a long time, I'm seeing people get so many things that I've never seen before. 2-1 buy downs, sellers paying closing costs, being able to negotiate some on the price, and usually not competing against a bunch of other offers. Now look, every market's different. Here in Oviedo, it's still fairly competitive, but it is a heck of a lot less competitive than it was when rates were 2 and 3%. So the opportunity, in my opinion, is not to wait for housing prices to fall, but to get in before there's a lot of competition and you can buy a house that you want, have time to negotiate, and get closing costs and some of those things that really will make a difference in you becoming a homeowner. We shall see. We are definitely going to pay attention to the data that's going to be affecting the market. Rates on their way down, unemployment on its way up. We'll see what the government does, especially this being an election cycle. And then on top of that, we are going to pay attention to where rates end up in 2025. We'll see if it's 5.5%. I think it'll be lower. We shall see. Anyways, this is Rayce Robinson, your favorite Florida mortgage broker. Have a great day, great week, and I'll talk to you soon.